food prices and fuel prices. Fuel we knew because the price was increased by the government by about 5 to 7 rupees. But food was always a guess. We saw cereal prices rising, we saw edible oil prices rising, and now it is in the inflation number. The important psychological mark is 4% because that's the MPC's given mandate. And now after an 18-month lapse, the inflation number, CPI inflation, has breached the 4% mark and gone on to 4.38. That's one negative. The other negative is that the best estimates or the highest estimates on the street were 4.3. So 4.38 is higher than the highest estimates, certainly higher than the CNBC TV18 average in the poll, which was 4.24%. So it's about, 14, 15 basis points higher than what the street was expecting. Joining us to discuss the implications of these and other data that was announced, which is the all-important June trade data, I have with me a bunch of top-notch economists. Madhavi Arora, the Chief Economist at Emkay Global Financial Services, Sameer Narang, Head of Economics Research Group at ICICI Bank, Amit Tripathi, President and CIO Fixed Income Investments at Nippon India Mutual Fund, and Srijit Balasubramaniam, Senior Economist at Bandhan AMC. Gentlemen and Madhavi, thank you very much indeed for your time. Let me start with the lady. Madhavi, how big a surprise is this higher number? Does it change your inflation trajectory for the rest of the year?
Hi, Latha. So, to a large extent, this inflation surprise is largely driven by food inflation. We were expecting the uptick to come from food, but clearly the delta of 20 bips versus our expectation of close to 4.2% is driven purely by food inflation. We were expecting fuel to go up on account of the pump price increase. But at this point in time, I think the rise in food inflation is purely reflecting one, the higher vegetable prices, and some modest pickup in cereal prices also, largely has been the case. My understanding is that the core inflation or the core inflation or core export inflation that generally people look at is also probably would have seen a mild increase of around 0.3, 0.4%. We still don't have a full breakup because the numbers are coming with a lag. But more broadly, I think apart from the food side, we weren't much of really surprised as such. But definitely it is 20 bits higher than our expectation at this point in time. But broadly, I'm not looking at this changing the inflation trajectory dramatically per se, because the recent data that we are seeing is also showing an uptick in mandi prices. But I think it's still manageable. It's not something which is very threatening for me to change my forecast.
Okay. Sameer, what's your sense? The RBI is sitting with, I think, 5.1 average for the current year, right? Because of this number, do you see that changing? There were some people who were expecting that it may not go to 5.1 when, in June we were lulled into the confidence that crude is at $70. At the moment now, it is difficult to accept that premise. So what is your inflation average for the year, and does your trajectory change because of this number coming higher than expected?
So interesting, Latha. Here, RBI's own average for Q1 is 4.2%. And the number would have come, I think, closer to 4% after this print.
3.93, I calculated that. And I was going to ask that as the next question, really, that it is still undershooting RBI. Go ahead, please.
Yes. So to that extent, the forward trajectory that we have prepared also shows an undershoot of around about 30-40 basis points. Q3, the undershoot, in our opinion, will be even higher. RBI is at 5.9%. We are 50-60 basis points lower than that as of now, given the current trajectory that we have. So overall, our view is the number settles around 4.8%. We were earlier at 5%. So we've brought that number lower by 20 basis points. A mix of factors. Largely, it's the international energy prices, fertilizer prices, commodity prices, all have come off, though they have gone up, but they are still far lower than what they were at the peak. So our opinion is that the number comes closer to 4.8%. So within that, food is going to be significantly higher this year because of a low base and an El Nino. But RBI is emphasizing more on core ex gold, which we believe this month would be around 2.5%. And that goes above 4%, in our opinion, only in Q4 of FY27.
Okay. Yeah, I believe it's 4.1 core, including gold. Obviously, you're saying excluding precious metals, it would be 2.5. Amit, I wanted to ask you, how should the market hasn't reacted at all. It is still working when the inflation number came, and the 10-year stood pat at 6.73%.
Would be worried too much at this point in time. The market has larger macro worries, including the flow worries, to grapple with. And I don't think the RBI would be doing anything in August, given whatever we have been hearing from them of late.
Okay, fair point. That's clearly how the market has responded at this point in time. And as Samir also pointed out, even with this 18 bips or whatever, 10 to 20 bips higher than expected June inflation, it is still below the quarterly forecast of the Reserve Bank, which stood at 4.2%. Srijit, therefore to you, what are you expecting in terms of Reserve Bank action even in the second half? Is there a scope that they will have to raise rates?
Yes, as far as the inflation print is concerned, we don't think this changes anything. What our view has been is that probably we don't see any rate hikes in August, but we could see at max around 50 basis points of rate hikes, but definitely not before October. Given where our second half inflation forecasts are, both headline and core ex gold, as we discussed, we believe the second half inflation could therefore average closer to 5.5%, while core ex gold could be closer to 4% or slightly above. That is what we roughly believe at this point. While the external account-related measures play out and the inflows happen, we therefore expect the RBI from a pure growth inflation second half perspective to go ahead with again, it's not a very emphatic view at this point in time, but at max probably 50 basis points of rate hikes, likely starting with.
Okay, fair point. I just want a word with our viewers before I continue with the conversation. We are all talking this jargon of core ex gold. The core inflation is a non-food, non-fuel inflation number, which the Reserve Bank is now giving more importance because they have started discussing or even disclosing their core inflation for the full year. So they're going to give it more importance. Food and fuel being more supply driven. Food dependent on monsoon, fuel dependent on geopolitics, and therefore core would be the inherent inflation of the economy. Core ex gold becomes important because gold gets counted in core inflation in India, and there was this unusual jump in gold prices in the past since October of last year. Very important to remember, October of last year, 2025, is when gold prices spurted from less than $4,000 to above $4,000, and by this February reached $5,200, and that pushed up the core to 4% plus. The analyst expectation is that RBI has declared this, that they will look at core inflation minus gold and minus precious metals, and that would come to about 2.5% as of today, which does not merit the MPC to move at all. But we must remember that after October, the math changes because the year ago gold inflation goes very high, and gold will become a minus impact on core. So if you're going to look at core inflation minus gold, at the moment it looks very good at 2.5. But as you come to October, November, December, it will look higher because gold will actually push up the non-gold inflation number. RBI is looking at 5.9 and thereabouts, which perhaps is not shared widely. So very quickly, all of you, just give me your inflation number for the full year. Madhavi, where are you standing?
Latha, we are still sticking with a 5%, a tad lower than the Reserve Bank. So we'll see how things evolve. But as of now, as I said, I think we should be able to close the year close to 5.1.
And you have any rate hike expectation?
I was never in the rate hike camp. So I think there's so many evolving parts. The market has become a joke. Everybody's just changing their rates forecast every now and then. I think on a very serious basis, I think the Reserve Bank would take it on a case-on-case point because there is so much fluidity in the market at this point in time that I think it would be really foolish for any central bank in the world to actually take a call on things. But I understand inflation is looking a tad higher in second half, but I think the problem for the Reserve Bank would be more about financial stability than focusing on pure rate hike, which I don't think is I am looking at this point in time.
No, actually, you have plenty of company if you are saying there is no rate hike, and you have plenty of company if you say there are two rate hikes. I think the market is equally divided. But Samir, where are you?
So our inflation number for the year is 4.8%.
Yeah, but where is the RBI? Okay, I mean, your RBI expectations.
RBI rate hike, we expect a prolonged pause. And the core X goal that you were also talking about, which they are emphasizing, actually goes around 4% and slightly higher than that only in Q4. So that is the most opportune time by when you can expect some action from RBI. And Latha, we believe that also gives time for the underlying recovery. We are going to see nominal GDP growth crossing 10% this year after 8.9% last year. So, overall, it fits into the overall narrative of giving time for growth and recovery to pick up. So that is why a prolonged pause is what we feel is likely to happen. And once the core ex gold inflation nudges above 4%, that is when the room opens up. Whether it does it or not, or the MPC, it all depends on what the outlook and global narrative is then.
Absolutely. Global narrative. Thank you for giving me the next question. Amit, that precisely is the point. The Reserve Bank has made it clear, it has walked the talk when it said that they will be guided as to their rate policy only by inflation. And if exchange rate deserves help, it will be given in a different fashion, which it did by opening the floodgates for FCNR deposits. But by the time we come to October or December, it is quite possible that Kevin Warsh announces, the Fed announces a rate hike. What is your expectation, therefore, from the Reserve Bank?
Latha, I guess directly, indirectly, I'll just borrow a few points made earlier. I think directly, indirectly, the RBI will be targeting nominal growth this year.
Okay.
And if they are very comfortable of the nominal growth reaching close to 11%, exceeding 11%, I think that is when their inclination towards rate hikes would be much higher. As of now, we are penciling in around 50 basis points with the assumption that we are going to a nominal number of around 11%. By the time we are in Q3, Q4, I think the RBI will be more comfortable reaching there, and that is when we will likely see that 50 basis point of rate hike.
Okay. What is your breakup when you say nominal at 11%? What's real and what's the inflation? Amit?
I don't want to second guess that.
Okay.
I think nominal is much easier to measure than the breakup to do. So I would say the nominal number.
Okay. Srijit, what is your nominal GDP number and the breakup?
So you're probably looking at somewhere around 12% plus for nominal this year, purely because of inflation.
Yeah.
Given that the WPI also carries a good amount of weightage,
And your inflation number would be if your real GDP number. You gave me your nominal around 12. What may your real GDP estimate be?
So that'll be around roughly just under 6.5%, and the rest being inflation. And because WPI, we expect it to average somewhere around 8% this year, given where we are at about 9% now.
Okay. Well, there are a couple of moving parts over here because now the MOSPI has also announced a PPI index. And if you looked at the PPI services, they have fallen 3 years for banking index or banking contribution index. So, we are in very jittery territory, even if you look at WPI, because WPI is getting replaced by PPI. I have my sympathies with you all. I have only to comment on what you are saying, but you have to make the actual numbers. But nominal GDP, I'm deliberately getting that number out because we had another very important set of data today, the trade data, which showed a 16% growth in exports for April, May, June. I think that's a number that will have a bearing on GDP as well. Those questions on growth after a break.
in exchange.
Welcome back to the State of the Economy discussion. We've got two hot numbers to discuss, which have just arrived on our plate. We discussed the inflation numbers and my guests, Madhavi from Emkay, Samir Narang from ICICI, Srijit from Bandhan AMC and Amit Tripathi of Nippon AMC have been telling me that it's a divided house. There are two people here who are not expecting a rate hike, Madhavi and Samir, and Amit and Srijit believing that there is a possibility of a couple of rate hikes, both for global and for domestic reasons. The news that we got, of course, was that the June inflation number at 4.38% is marginally higher than what the street expected. The street was prepared for between 4.2 and 4.25%. But the other big number that arrived on our plate was the June trade data, where we saw very good, goods exports number, but trade deficit was higher as expected because of a very high import number. Crude oil imports jumping by 40%, overall goods imports jumping by 30%, leading to a fairly high trade deficit number of $30.43 billion. It's not a record high. In October of 2025, we had $40 billion as the goods trade deficit, but nevertheless higher than what we had in May. As well, services exports have not done brilliantly well. It is $33 billion compared to $32 billion a year ago. So it's only a 3% increase. And hence, there is an issue of the trade goods plus services deficit being a little higher than what it was in the first quarter. What does all this mean for the growth number itself? Let me ask the economists here. Madhavi, your thoughts first. The goods exports have been very good for April, May and June. Therefore, does that encourage you to believe that we have something good going in terms of growth for the rest of the year as well? So I want two numbers from you, your full year growth forecast and your first quarter growth forecast.
For exports or for the economy? I'm sorry, I missed that.
For the economy,
The economy, okay. So just with regard to the trade numbers, I think as you rightly said, the export story has been quite resilient despite the fact that, we've sort of passed through a very noisy tariff era, and plus logistical issues also have been, a big concern. But overall for the quarter as a whole, exports have been quite resilient. Interestingly, what is basically moving exports is, again, electronics. This is also a big component of our heavy imports beyond crude. But nonetheless, I think on a trade basis, if we are expecting Brent to somewhere settle close to an 80 average, I think we should be able to see a current account close to around 1.5 to 1.6% of GDP, which would be manageable given now we are looking at an easy funding of current account as well. On growth as a whole, we are still sticking to a 6.3%. We really are waiting for the oil market to actually sustain at a certain level for us to really take a call whether there could be an upside to our growth forecast. But I still believe that even if we see oil prices somewhere settle close to $80 per barrel, my sense is that we are still going to be not seeing growth above 6.5% for this year on a real basis. On nominal, we are looking at around 13% because our WPI forecast is now hovering close to 8.5 to 9%.
Okay, 13% nominal growth.
12.8 to 13%
Okay.
could be.
No, that would be very good news for the economy itself, because obviously one would expect tax buoyancy, etc., also to jump along with the kind of nominal.
It's start inflation led, just to get an understanding of.
I agree that. I agree with you. But that inflation also means higher revenues. I mean, you can see it in some of the earnings that have already been announced. And thank you for also reminding me that we have to discuss the BOP and current account deficit numbers as well. Samir, what would be your growth number as well as your BOP number, having looked at the trade deficit for the first quarter?
So for the growth number, we are now at around 6.9% real for the year. Earlier, we were around 6.5%, so we've revised it higher. You'll ask why. Well, if you look at the HFIs that have come out over the last couple of months, all of them are showing a broad-based recovery, uptick in momentum. In fact, if you look at the passenger vehicle or two-wheeler sales, even the entry-level product segments are doing very well. So if you add all of that together, it's very clear that growth is going to surprise on the higher side despite the external headwinds. The entire growth cycle started turning after the GST rate cuts led by auto sales, and it has sustained with credit growth recently coming upward northwards of 18%. So all of that put together, we believe Q1 growth should be around 7%, and for the year we are around 6.9% on a real growth basis as of now.
Okay, Samir, actually, I will not ask you why are you so high at 6.9? I would actually ask you why are you so low at 6.9? Because my own number is well over 7%. I don't have sophisticated models like y'all, but I think a credit growth of 18.6%, an export growth of 16%, auto sales growth of over 20%, no matter what you pick, two-wheelers or cars or commercial vehicles, is all telling me something different, but I defer to your opinion. Srijit, any view on the first quarter number itself, which we should get end August?
I think, see, the first quarter number, although the trade data has been good, I'll be cautiously optimistic there because there is some element of inventory management also that's likely playing out. So what we've seen from the PMI data, etc., has also been that, just after the onset of the war, there's probably a price effect and a volume effect because, probably, some of the companies wanted to front load some of the inventory accumulation, etc. So we'll have to see whether this momentum sort of sustains or not. And this effect, like I said, could be both from the price and volume front. Credit data, right, it has been quite strong. And therefore, for a full year, we continue to expect somewhere around 6.5% real GDP growth.
Fair point. That seems to be the average on the street, 6.3 to 6.9. And I think both sides are represented here. And the Reserve Bank sits bang in the middle at 6.7. So I am the outlier at well over 7. Amit, a final question to you. What are you all penciling in by way of FCNR deposits coming in and that meaning a liquidity gush for the market? When are you expecting it only in September or in August as well? And do you expect any unusual steps from the Reserve Bank?
I think it's pretty much higher.
Sorry, Amit.
What I'm saying is, obviously, you are looking at some build-up from July onwards itself.
We have been a little unlucky with the technical aspect over here. Okay, we will get to Amit at some other time. The key takeaways from our experts is that we are still a little downbeat on growth, with most people expecting between 6.3 and 6.9. I think the majority is veering towards the lower number. But we'll have to wait and see. There is a lot of compelling data which might make even the first quarter number closer to 7 than the 6.6 which the Reserve Bank has forecast. But much more important is that inflation is definitely undershooting what the Reserve Bank has forecast at 4.2. And therefore, although the June inflation number itself is higher than the street expectations, the market is not expecting the Reserve Bank to move in August. It will in fact say that we are looking through this number for the simple reason that it is below their own forecast and core inflation is way below the 4% mark if you deduct precious metals. That's the takeaway from the inflation numbers itself and on the state of the economy. Thank you very much, Madhavi, Samir, Amit, if you are still able to hear us, and Srijit for participating in this conversation. That's it on this edition of State of the Economy. Stay on with us. There's more news and updates.